We're going to talk about the question of what can you do with your taxes. I just came off a tax deadline and whoo, always so fun, great time, looking at a lot of tax returns, looking at a lot of numbers. And, making a few observations, as we work with clients about some of the finality that takes place when it's our turn to go and look at their tax return. And what I mean by finality is that, whether you recognize this or not, most individual tax filings, really all of them actually, are run on what's called a cash basis accounting, which means, what happens in the course of the year from January 1st through December 31st is what can happen over the course of the year. So when you go and take your tax filing over to your trusted tax professional to have them go and take a look at things and see what they can do to help you out, the truth is there's not a whole lot that you can do any longer by the time you give that information to them in January, February, March, April the next year, because we're no longer in that tax year. That tax year, 2024, was January 1st to December 31st. So what can be done, what should be considered, has to be done then in that period of time. If it's done after the tax years come to a close, there are some things that can be done, but there's not a whole lot that can be done. And so just the value and the benefit of working and talking and collaborating with somebody before the end of the year, not before your taxes are due, but before the end of the tax year, just to see, like, if you want planning, you want advice, you want to be like, oh, what can you do for me? Like, that time to have that conversation is in August, September, October, maybe November if they're still available. Definitely before December 31st, or there's not very much that I can do for you. I mean, it's what happened has happened, and it's a settled matter, and there's not anything really we can do because we're in the next tax year by the time I'm talking to you, if you're talking to me in March. So that would just be one thing I would hope for folks to realize and appreciate, is that there's a finality. Once we get past December 31st, by and large, our options are limited. That's not completely and always forever true, especially if you're self-employed. There is some flexibility associated with retirement accounts in particular, but other things that, considerations that we can make. But in particular, if you're, a W-2 wage earner, what's been done has been done. And the work of the tax professional, the point is just to properly report that and, complete it in compliance with the IRS and regulations. That's their work. It's not their ability to go and make changes or consideration. So, a few things in which I would encourage someone to go and reach out for, tax advice is, let's say you're having a distribution from a retirement account, and maybe it's, for very real reasons. It's because, there's been a medical sickness, unexpected medical sickness, and we need the money to help make ends meet. Maybe one of us is no longer producing income in the household. Then let's distribute that money. But to flesh out fully the tax implications of that, we certainly had a few instances in which retirement distributions took place, and it was just like, oh golly, I wish I had known about this, or you had chatted with me, because we might have done this only a little differently, or at least help plan for the tax impact that was expected to have. Another thing that would be helpful, I think, that I would like to pass on to people for their consideration, is just if there's a large sale of stock, company stock, and especially with embedded gains on that, and just the difference in taxes between short-term gains versus long-term gains, and the tax rates that take place, which tends to be at least probably a 10 to 15% spread. You can miss short-term or long-term capital gains by just a matter of a few days. And so, whether to have held that stock for just a little bit longer and to have stretched it out maybe into some long-term capital gain taxation instead of short-term capital gain taxation can certainly be worthwhile. Another consideration would be for capital gains. And that this time isn't the selling of stock, or more so maybe company stock, which is where we tend to see the biggest increases in gains. But there was a company in particular in which we saw significant gains, a publicly traded company that over the course of 2024 did really well. But there can be just in mutual funds that you hold, have internal turnover within the fund itself. And so you have what are called capital gain distributions that take place that even if you didn't sell that mutual fund, you just held it all year. And you would think, well, I didn't sell it, so why would I have to pay any gains on that because I didn't sell? Uh, the reality is that if that mutual fund, if held in a taxable brokerage account, has internal turnover to it and has ultimately net profitable income, those that taxation comes home to you as the individual investor. And so, there can be a huge impact in tax efficiency between an investment that has minimal turnover in it and consequently minimal capital gain distributions versus one that has a lot of turnover. And so even if you have a mutual fund that's high flying and performing and beating and doing better than everybody else, that 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 fund hasn't that return that you're wanting to see on that fund hasn't been fully manifested yet, because it can also then have tax impact that has to be captured and picked up on the return. And some we have seen where those capital gain distributions get to be quite a bit of money. And it's not necessarily to a point where like someone like, oh my gosh, I go from having a refund to owing. Could be, but it's like it ate into what would have been your refund otherwise. Like it, comes into several $1,000s, if maybe not $10,000 or more. So, we had one client in particular that comes to mind in which, golly, they had quite a bit in capital gains that really hadn't been passed on to them to their investment advisor. I don't think they were aware. Their investment advisor was just kind of doing what they do and shows up on the tax return, and now they got to go and pay for all those actions. So having some tax efficiency with your investment management can be a big game changer, and is part of that investment management is knowing what kind of takes place on the tax side of things. So those are some of the considerations that come to mind to me. I mean, there's so many, though. We could be talking about rental properties and the impact there, running a business and business write-offs. So certainly others to go into, but just like kind of more mainstream situations, those are a couple that come top of mind. So let's have you work with a tax professional. We'd love to work with you guys if you are interested in what we do. Schedule a call. Let's have a conversation. Let's see if we're a good fit. And, maybe we can be your tax advisor. That'd be great news.